In this video, we're going to be doing a brief stock analysis of AT&T stock, ticker symbol T. So they've recently had some news come out about some various things. So they've released their fourth quarter earnings. They released their 2020 10K, so we'll be looking at both of those a little bit. And then even more recently, just a few days ago, they announced that they're basically going to be spinning off sort of the DirecTV segment with a private company. So AT&T will still own part of DirecTV, but they'll be getting some cash from that and be able to put that towards debt. But we'll go into all those details in the video, so make sure you stick around to the end to hear about all of that. Hey, what's up guys? Welcome back to the channel. If you don't know, my name is Frank Mularcik, and on this channel I talk about everything related to stocks and the stock market, investing, personal finance, pretty much anything related to that. So if you are interested in that, make sure to hit the subscribe button so you don't miss out on any of the future videos. And also, if you appreciate it, like the video, as it's a great way to help the channel out and help us grow a little bit. So without further ado, let's get right into this AT&T stock analysis. Alright, so the first thing we're going to be looking at is some of the results from the fourth quarter. We're just going to be looking at the earnings release. So if we scroll down here, to some fourth quarter highlights, they talk a little bit about some of the specific numbers of how many customers they're adding and things of the like. So that's pretty interesting. We're not going to go into every single detail here, but if we look at HBO Max, that's one of the areas that has really been growing well for AT&T, and a lot of AT&T investors are probably excited about that as one of the super awesome areas of their business that they have. So their total users topped 41 million domestically and 61 million worldwide, and actual activations have doubled since the end of the third quarter, which is up to about 17.2 million. So I think that the activations is more of a long-term membership or more of a commitment type thing to HBO Max. So that's sort of a more important number, and maybe these 41 million numbers are a bit misleading. So maybe this 17 million is what we should pay attention to a little bit more. For the fourth quarter, revenues total about 45 billion versus about 46 billion last year, and obviously the COVID-19 pandemic impacted these revenues across pretty much all of their business segments. And then if we go along here, operating expenses were also high, around 56 billion versus only 41 billion last year. So definitely a substantial increase because of some increased costs due to COVID-19. They say higher non-cash impairments or non-cash asset impairments and abandonments, which includes 15.5 billion for the video business. So just some various things there. HBO Max investments, so that's definitely good to see that they're investing on HBO Max. Unfortunately, they did have a operating loss this quarter of almost $11 billion versus a income of 5 billion last year, but I think a lot of that was due to the pandemic and the impact of lower revenues. They said operating margin was negative 23% versus 11% last year, but they say when adjusted for non-cash asset impairments, merger amortization costs and other items, operating income was positive 7.8 billion versus 9.2 billion in the year ago quarter. So it's good to see that obviously these are just some kind of accounting conventions, but when you take those into account, they did have some income. It was a little bit down from the year before, but they did have some. So they go through the net loss attributable to common stock, which is even more at almost 14 billion, but they say that their earnings per diluted common share here was 75 cents compared to 89 cents a year ago. Cash from operating activities was 10 billion with capital expenditures of about 2.4 billion. So that leaves free cash flow of about 7.7 billion for the quarter. And they say net debt declined by 1.6 billion sequentially in the quarter. So that's obviously good to see them lowering their debt. Obviously, I'd like to see that a little bit more aggressive, but we'll talk about debt a little bit later as well. And then looking at full year, their consolidated revenues were 171 billion compared to 181 billion last year. Obviously, they list a bunch of things for the reasons. Operating expenses were a little bit higher at 165 billion compared to 153 billion. So obviously, if you just think about it logically, if the revenues are going down and the expenses are going up, then you're going to have a lot thinner margins and probably some losses there. So that's actually what happened. So 2020 net loss attributable to common stock was $5 billion or 75 cents per common share. And last year they had almost 14 billion income attributable to common stock. So really a 20 billion difference there. Cash from operating activities was 43 billion. Capital expenditures of 15 billion, which leaves a free cash flow of 27.5 billion compared to 29 billion in 2019. So the free cash flow itself really was not that much lower. And then they say the free cash flow dividend payout ratio was about 55%, and net debt declined by 3.5 billion in the year. So that's really not that much. I thought it was a little bit more, but we'll actually take a look, like I said, at debt later. They talk about 2021 outlook with just a slight revenue growth and pretty much stable EPS from 2020. They're planning to invest about 21 billion with capital expenditures in the $18 billion range. And they say that they expect free cash flows to be about 26 billion with a dividend payout ratio in the high 50%. And you can, if you remember, the free cash flow from 2020 was 27.5 billion. So they're actually expecting that free cash flow to decrease a little bit. Also, we're going to look at some numbers from the 10K. So this is just some selected financial data that they show us. Some of this we already looked at. So the revenues, 171 billion, expenses of 165 billion, the operating income of 6 billion, and then their actual net income or loss was about 3.8 billion, and then the portion attributable to common stock is about 5.4 billion. So it's obviously not great to see. You can see that their shares outstanding are decreasing a little bit from the previous year, but it looks like they have increased substantially from a few years previously. But they did show some data on share buybacks, and in this 10K that I was looking at, just a brief bit, and I think that they are continuing to focus on share buybacks little bit by little, so it's not going to be anything crazy, but I think slowly these share buybacks will be decreasing the number of shares. And then just looking at some numbers here, the total assets are about $500 billion, 525, which is pretty awesome. But as we can see, their long-term debt is 153 billion, and that total debt is 157 billion. So I wanted to talk a little bit more about debt, and some of that is related to the 5G auction. So the Seeking Alpha article is about a month old, so the full results of the auction weren't out at that point, but as of that time, AT&T had decided to finance some of its investments with this auction via a $15 billion loan from Bank of America that comes with a 1-year maturity. So they have to pay this back in a year. And that seems like a fairly large amount that they'll have to pay back within 1 year, but obviously that's just for 1 year, and hopefully in the coming years they'll have less debt that's due. And then if we look at this article that came out more recently, in total, the total amount they spent in the 5G auction was about $23 billion. So overall, we saw that their total debt was about 157 billion. So if we add that 23 billion of debt from the 5G auction, that brings them to about 180 billion dollars, which is pretty substantial, and they haven't been at that amount at least at the end of the year in any of the past 5 years, as we can see here. But there is one sort of good thing that we're also going to touch on, which is the spin-off of the DirecTV. So basically this TPG capital firm announced today that they have signed a definitive agreement under which the two parties will establish a new company named New DirecTV that will own and operate AT&T's US video business unit. So basically, let's see, New DirecTV will be jointly governed by a board with 2 representatives from AT&T and 2 representatives from TPG, as well as a 5th seat for the CEO, which will be Bill Morrow initially, who is the CEO of AT&T's US video unit. And following the close, AT&T will own 70% of the equity and TPG will own 30%. So T is still going to own a fair bit, I guess, of this video unit, but it's kind of going to be a separate entity, so they don't have to deal with it as much. And then we're going to look at the transaction a little bit. So it's expected to close in the second half of 2021, and AT&T expects to receive about $7.8 billion from DirecTV, and AT&T expects to use the proceeds to reduce AT&T debt. So if we just say they have $8 billion there that they're receiving, and they can just put that all towards the debt, then that would bring the debt down from the $180 billion that we just discussed to $172 billion. So that's not great to see, but I think overall the 5G investments, it's something they have to do to keep moving forward and keep up with these other businesses in the space. And the thing is that AT&T as a stock often gets compared to Verizon a lot, and the thing is that Verizon has over $100 billion in debt, and looking from this article, Verizon spent $45 billion in this auction. So after this, I think Verizon isn't going to be that far behind AT&T in the amount of debt they have. So that's something to consider when maybe deciding between AT&T and Verizon, is now they're really not that much different in the amount of debt they have. So obviously we have to look at the dividends. So their forward yield is 7.46%, which is pretty high for most dividend stocks. But like we saw, they have the free cash flow to pay that dividend, and even their EPS to payout ratio, I think, is what Seeking Alpha uses, is 66%. So obviously the 1-year growth rate is pretty low, and they haven't even increased their dividend in 2020, so they have to increase it sometime within 2021 to retain that aristocrat status. But they have that aristocrat status of 36 years of dividend growth. So obviously that shows they're sort of committed to the dividend, and I think they will increase it in 2021, and I definitely hope they do, but I don't want to see them doing any crazy increases. I want them to continue focusing on paying down that debt as much as they can. Looking at the recent stock price isn't like the foremost thing you want to look at when deciding whether to invest, but it can be something sort of valuable. So you can see they're really depressed here. Over the last year, they just took a huge hit in last February and March due to the crash, and really just have not recovered. And over the last month, they've really plummeted off this last week here. So obviously it's not the most compelling investment for most people, but there is a big reward there with that risk you're taking on of that 7.5% dividend yield. And looking at my position in my portfolio, I currently have 1.82 shares, which is about $50 of equity, and this is about 4.2% of my portfolio. So I really haven't added much to AT&T at all in the past few months. So AT&T has slowly been dropping to a lower and lower percentage, and I'm really happy with that, to be honest, because I really don't want it to be too big of a position. Like, you can see Apple is a smaller position, Aflac is a smaller position. Like, I want all these companies to be bigger positions than AT&T. But really with these depressed prices the last week, like we haven't seen in a few months, I might have to consider picking some up, but we'll see how it goes. I'm not exactly sure. So what are my overall thoughts on AT&T? Well, they're definitely a risky investment. Obviously, the biggest concern everyone has is that mountain of debt they have, and that definitely is a big concern. So that's why I want to continue reducing that position size in my portfolio, like I said. But there is that trade-off with everything. For the risk that you are taking on, you do receive a nice reward of that 7.5% dividend yield at the moment. Usually it's sitting around 7%. So that is something good about it. They do have tons of free cash flow that they're bringing in from their businesses that they're able to pay that dividend with, and it really hasn't been a problem. But also they could use some of that free cash flow to really pay down the debt as well. So it's really a trade-off, it's really a risky investment, but overall I'm willing to take on some of that risk in my portfolio and look to their dividend history, their strong dividend history, and their strong payout ratio, and say, well, I think that they're going to keep paying that dividend, keep slowly increasing that dividend over time, and if they are able to pay off a lot of that debt, we could see some nice capital appreciation as well, because they've just been trading sideways and down the past few years, really. So if they are able to turn around some of this debt, that would really be good for the company. But you know, they just keep taking on more debt. It's just kind of frustrating. Like the past few quarters, I was getting excited. They were paying off like $5 or $10 billion every quarter, and then they come out with this 5G auction and they take on $24 billion more of debt, and you know, that just doesn't feel good as a shareholder. So obviously that debt in the long run is going to be good because they're using it to invest in 5G and get some contracts and business with their 5G business, which is obviously the future. But it's just it's hard to invest in a company like that. It's hard to take on that risk for me. So you know, I am still invested. I do still like the company, but it's just, like I said multiple times, going to be a smaller part of my portfolio. And all the figures and numbers and research we went over in this video, it was not super extensive. It was not covering all the things you should be thinking about. So I would encourage you to do more research if you are considering investing in AT&T. Like I said, it's definitely a pretty risky investment as a dividend investment goes, but you do get that reward of that nice dividend. So that's what I think about AT&T stock. I hope I was able to help give you guys some insights into the things going on recently with them. If you do want to watch some more videos of mine, I will leave some links up here, and I will see you guys in the next one.